Welcome back. I'm Chris Hayes. Rachel has the night off. In coordinated raids this morning, FBI agents executed search warrants in Boston, New York, and Connecticut at the offices of 3 hedge funds: Lock Capital Management, Level Global Investors, and Diamondback Capital Management. The searches continued until early this evening and are part of a massive 3-year investigation conducted by the Justice Department into what sources there are calling an insider trading ring that netted millions of dollars by trafficking in non-public information about companies. The Wall Street Journal reports that, quote, the investigations, if they bear fruit, have the potential to expose a culture of pervasive insider trading in U.S. financial markets, including new ways non-public information is passed to traders through experts tied to specific industries or companies, federal authorities say. One of the firms being investigated, according to the Journal, is our old friend Goldman Sachs, which Rolling Stone's Matt Taibbi famously described as, quote, a great vampire squid wrapped around the face of humanity, relentlessly jamming its blood funnel into anything that smells like money. Now, no one, as far as I know, is arguing that the alleged activities of insider trading in stocks had anything to do with the financial meltdown. In fact, the meltdown happened not in the old, sturdy world of stocks, but the new high-flying and increasingly arcane universe of derivatives, swaps, and alphabet soup instruments. But today's FBI actions provide a good occasion to marvel at just how little there has been in the way of criminal law enforcement in the wake of the largest financial crisis in 80 years. $8 trillion of wealth vanished, leaving an economy hammered hard by the worst recession years, working people bearing the brunt, record bonuses and profits on Wall Street. And there's a ton of anecdotal evidence, from lawsuit depositions to interviews I've conducted for a book I'm writing, that much of what created the crisis was systemic deception and institutional corruption. Yet, aside from Bernie Madoff, we've seen hardly a perp walk or conviction. So what gives? Part of the problem is that actually bringing financial fraud cases, is very difficult. In 2009, the federal government tried but failed to convict 2 Bear Stearns hedge fund managers for securities fraud. Convincing 12 jurors beyond a reasonable doubt of ill intent while guiding them through a dizzying array of complicated numbers is an exceedingly tall order. But part of it has to do with the mindset with which the governing and financial classes have come to view the crisis. In the minds of those who run Wall Street and Washington, the entire financial meltdown was a kind of collective error in judgment. Nothing untoward about it, no bad faith, just fundamentally good faith mistake that a whole bunch of very wealthy and powerful firms and economists and politicians made. We thought the housing bubble would last forever. We thought people would pay back the loans. We thought these financial instruments were distributing and reducing risk, not exacerbating and multiplying it. It turns out we were wrong. Mistakes happen. Let's move on. There's another way of interpreting what happened, which is to view the entire chain of housing bubble mortgage securitization as a giant Ponzi scheme, fundamentally predatory in nature and predicated on deception. In other words, you have to use the F word: fraud. Now, these 2 ways of thinking about what happened aren't mutually exclusive. In fact, it was probably some combination of both. But I was struck when I read Michael Lewis's masterful account of the crisis, The Big Short, by a quote from one of the book's protagonists about exactly this good faith, bad faith distinction. There were more morons than crooks, short seller Vincent Daniel told Lewis, but the crooks were higher up. The crooks were higher up. It goes a long way towards explaining why we haven't seen more prosecution of the crooks. If we're going to avoid another crisis, that's going to have to change.